Hey, BUS20 students, this is Mr. Doucette, and I wanted to fulfill my promise to do a few problems from chapter 16, and then I'm going to do a second video for some problems with chapter 17. Chapter 16 is on inventory and chapter 17 is on depreciation. And so I'm just going to take it right out of your textbook today, but I'm going to do a few problems just to show you how to work out these different kinds of inventory problems. And of course, inventory is very important when it comes to business. A lot of your finished product ends up in a warehouse, and there's dollar value to those products that are in the warehouse. And so being able to put a dollar value to them helps your income statement either look good or look bad. And so this goes into one of the lines on your income statement, which we haven't looked at financial statements yet. We'll be looking at that next week. But it's very important that you have an accurate count or value of your inventory, because that goes into your assets for your business. And so figuring out what your inventory is worth is really the critical piece. And then of course, what you've sold versus what you still have, and which items did you sell? Were they the ones that were more expensive, or were they the ones that were less expensive, etc.? And so these are the kind of problems that we work out with chapter 16 on inventory. And so and another way to look at it too is sometimes you buy products and then you resell them, and that's how a lot of businesses work, Walmart, Target, whatever. So they're buying products from somebody else and then they're selling them. But when they buy them, sometimes they buy them at different prices, or maybe they're using a number of suppliers and they're getting them all at different prices. So then when they go back to count their inventory, they're not all the same price. And so being able to calculate that is kind of what these problems show us how to do. So a couple things I want to mention to you right off the bat is there's three different methods. Actually, let me show you our screen. I'm going to stop sharing this and I'm going to share my desktop. And I apologize for being so casual at the moment. Unfortunately, this is like the fifth take of this particular video. I've been having a lot of trouble with it, so I apologize for that. All right, so here is our class in Canvas. I'm just going to select that. And I'm going to show you one thing in here. So if you go down to modules, you can click it on the left, or you can select the module red button in the middle. That's actually faster because it brings you right to our week. So we are down to week number 7. And I wanted you to note here in this study section that I have PowerPoints, I have a summary, and then I have the homework. And I've rearranged these homework assignments to be hopefully a little more directed to you. If you notice here under review, I have inventory valuation, and I have section 16.1, 16.2, 16.3, and that's it. That's all you need to be concerned with when it comes to inventory. There's a few more sections in this chapter, but you don't need to do those. All of the questions on the quiz and all the questions on the exam will be covered by these 3 sections that you're going to work out. So, and notice here I say 16.1, example 1, page 535 to 538, Fifo. Now, Fifo stands for first in, first out. So it's processing your inventory based on selling the items that were oldest in your inventory. So the first ones you put into your inventory, those are the first ones you've sold. And then on 16.2, it mentions LIFO, L-I-F-O. That's last in, first out. And so the last items I put in, those are the first ones I sell. And then average cost basically takes the cost for all of your inventory and then does an average on it, and that's the easiest of the 3 forms. So we're going to be looking at each of these, and let's go ahead and get started with that. All right, so here's an example of FIFO, first in, first out. That's what it stands for. Let's just say that you're manufacturing a product and you're finished manufacturing them. You don't have them sold yet, and so they basically get put into a warehouse. So you might put them into the warehouse, and we'll just kind of number them 1, 2, 3, 4, 5. So there's 5 widgets that you've made. And let's just say that you sell 2 of those, right? So the first ones that you would ship out are the first 2 that you put in. So you would get rid of that, you would get rid of that. And what you have left is what you have still in inventory. Now, the key to this is maybe the first one you put in cost you $50 each to make, and then the second one you put in cost you $45 to make, and then the third ones you put in cost you $55 to make, and so on. Each time you made it, it was a little bit different cost to you, And so whatever you have left in your inventory is what we call remaining inventory. And then whatever you had at the start before you sold anything is what we call beginning inventory. So all 5 of these would have been beginning inventory. And then, or maybe there was already some beginning inventory in here. So let's just call this beginning inventory. And let's just say you went ahead and you built 5 more of these items. So let me start over here. So you built 4, you built 2, and you built 1, right? So there's 1. All right, and so beginning inventory is what you had in there, and then you added all these 5 other ones to your inventory. So your total inventory is whatever that equals, adding all those up as far as dollar value. But then when you started to sell them, let's just say that you sold what was already in there first. So you sold, plus everything was in there plus the next 2. So you sold all of these and all of these and all of these. Those would be the first ones out. So whatever you sell is what goes out first. Or what you put in first is what goes out first, and then whatever's left is called your remaining inventory. So we'll look at this in a problem here, and maybe it'll make a little more sense. Okay, so here we are in your book. And by the way, in your book gives a nice little illustration of this first in, first out. Here's another example of it. You have a little warehouse here, and the truck's coming in, and he's stacking up, number 1, number 2, number 3, number 4, number 5. And then when they're going to ship them out, of course, the first one to go out was the first one you put in. So whatever was there first or whatever was there the longest, that's what's going to go out first. So we're talking about first in, first out inventory. And so, of course, your book gets into some different problems, and I'm not going to go over them because you can do that. But on page 537, there's example 1, and that one is a Fifo. It's assumption that the inventory cost flow is made up of the most recent costs. So there's 700 picture frames. And you can see here, here's the picture frames. And so 200 of them were from December 9th. 300 of them were from October 15th. And notice how they're all different prices. So their total inventory was 700 on December 31st, but then they sold some, right? So they sold 200 units. Let's see, what did they have left over? So it says extend the so they had 700 in there. Oh, and that's the total value of their inventory is this right here. So if they were to sell the first ones first, which first in, first out, which were the first ones in? Obviously the ones on December 8th. Those were the first ones in. So those would be the first ones that you deduct. So if I sold 400 units, then that means the 200 from December 8th were ones I sold. And then 200 from the October 15th. So there's 100 left of those. So if I sold 400 and I said I sold 400 using first in, first out, then what's left is what I put in there in December 31st. Excuse me, that would be the inventory. What I put in there in July 19th, that's 200 plus 100 left over from October 15th. And I would do the math. I would take the 100 times $8. I'd take the 200 times $7. And my remaining inventory would be 300. And of course, the dollar value of those would be accordingly to how many they sold. So let's look at this in a problem. Your book is asking us to do this problem by Best Buy. And they're asking us here, they're saying there's a beginning inventory of 200 units at $8 each. And then on May 14th, they purchased whatever it was, picture frames or whatever, and they put it into their stock and they paid $8.50 and they bought 100 units. And then again, on August 27th, they bought more. 250 more at $9 each, and then November 18th they purchased 300 more at $8.75 each. So if you add all that up, what's in their inventory at the moment, they have 800 units in inventory for a total of $7,325. Using the first in, first out method of inventory pricing, what is the dollar value ending inventory if 380 video games were on hand December 31st? Meaning that they sold 300, they had 380 remaining, and so they had 850 to start. So 850 minus the 380 would be considered what they sold. So which ones did they sell? That's what we'll figure out next. Okay, so they had 850 in total inventory, but they only had 380 left at the end of the year. So that means they sold 470. And the question the answer that the question is seeking is what is the dollar value of the $300 or the 380 remaining. Now I can't show you the screen again, but if we go by the dates that were given, okay, so here's the dates. So if it's the 300 remaining and I sold the first ones I put in, then what would be remaining are the last ones I put in, right? So in this case, the last ones I put in were on November 18th, I put in 300 units. On August 27th, I put in 250 units, and everything before that would have sold. So if I have 380 left, and on November 18th, I had 300 units, 300 units at 875. So that's remaining. Those 300 are still there. I didn't sell those. Those are the last ones I put in. Plus, there was also another 100 from August 27th, or actually 80 from August 27th that were remaining. So those cost me $9 each. So basically everything prior to that I sold because those are the first ones I sold. So all I have is what's left. If there's 380 left, they're going to be the last ones I put in, right? So I'm going to multiply those two up. So my total is 3345. So if I have 380 items left over on December 31st, and I'm using the first in, first out method, that means I sold all the ones that were in there the longest, or the first ones I put in. Again, I put in on January 1st, 200 units at $8. On May 14th, I put another 100 units. And then on August 27th, I put 250 units. And so I sold all of the ones on January 1st. I sold all the ones on May 14th. And I sold everything but 80 of those on August 27th. So what remains then is 80 that were August 27th. And I know those cost me $9. And then the 300 I put in on November 18th, those are still in the inventory. So I have a total of $3,345 worth of inventory still in inventory. So that would be using the first in, first out method. It could be a little confusing, but just keep in mind the idea of a warehouse, like I showed you. And that warehouse gives you, as I showed you here, everything going in first is the first thing that comes out. And whatever you put in first, whatever is the oldest, those are the things that you're going to sell first. So if there's a beginning inventory, before you put anything in, that beginning inventory is going to go first. And then everything that remains will be what you put in last. So that's first in, first out method. Now we'll look at the same thing using last in, last out. Last in, first out method. All right, the next kind of inventory that you want to that you'll find is very common in businesses using the last in, first out method. And that's very similar in the sense that, let's just say, again, I put in 5 items into my warehouse. We'll even say beginning inventory is there. And then I put in 5 more items, right? And so then let's just say I sold, in this case, we're going to use the same problem here in a minute, but let's just say I sold, 150 of those particular products. If I'm using the last in, first out, then the ones I put in last would be the first ones I sell. So whatever I have remaining is what I put in there first, right? So in this case, if I sold, let's just say it was 250 or whatever, then I would have sold this one and maybe half of that one, right? Because those are the ones I put in last. So those are the ones I sold. So what I have remaining is what was already in there before I put those in. And so I need to figure out the dollar value of each of those. Again, to go back to your book here, let me share my screen on the book. And so here's the last in, first out illustration. You have your truck coming up and they're putting in, each one. So there's 1, 2, 3, 4, 5. And then, however, when they're getting ready to ship them, they don't take number 1. They don't take the first one they put in and ship it out first. They take the last one they put in and they send that out first. Now you might say, well, why would they do that? Why wouldn't they want to rotate? First in and first out is like rotating your stock, always getting rid of the oldest first. In last in, first out, it's the opposite. You're trying to get rid of the most recent ones first. And a lot of times they do that for tax purposes because maybe the cost of doing the latter ones was cheaper and they want to get a bigger tax break and they want the ones that were more expensive to remain in their inventory so they get a better, gross income at the end of their income statement. So there's different reasons they do, but usually it's tax purposes that they'd switch. So sometimes during certain seasons, companies might use first in, first out. And then in other seasons, they might switch to last in and first out. So let's look at this now in the problem in the book. So if you scroll down now, we're going to use the same problem. Here it is right here. It says, let's see, oh, down here. So let's try it. So using the best by data, the same data that we used before, let us now do it using the last in, first out method. So I'm going to go back for a second to that table that we had. So here it is again. So on January 1st, we had a beginning inventory that was the oldest, that was already in there, of 200 units. Then on May 14th, we purchased another 100 units and added them to our inventory. And then we purchased another 250 on August 27th and put that in there. And then on November 18th, we purchased another 300 units and we put those in there. So which ones were the ones that were put in there last? Well, of course, November 18th. And then prior to that was November 27th. So the ones that are going to come out first are the ones that we put in last. So whatever we sold comes out from the list at the bottom of the list and then upwards. So in this case, the problem is asking us, if we scroll down to it, it's asking us, use the data from page 538, and let's assume that the dollar value of the remaining ending inventory is 380 video games using the LIFO method, right? So let's go back one more time to this table. So 380 left over, right? Well, if I sold what came out first, so if I sell what I put in there last, that means the ones, if I have 380 remaining, right? So probably the easy way to do it is to start at the top this time. But since these are already gone, that means these are definitely still there. So I have 200 in January, I have 100 in May, and then I'm going to have 80 again from that August 27th. But all of these other ones sold down here, right? They're gone because those are the last ones I put in. So those are the first ones that went out. So whatever I have left was there the longest. In this case, January 1st and May 14th. So let's go back to our worksheet here so I can work this out for y'all. Hopefully this isn't too confusing. So we're going to share that. I'll share my iPad screen. And we are going to go here. So let's delete this page here. So here we go. So again, we have 380 remaining using the FIFO method. So again, the last ones I put in were November 18th. So those are already sold. Again, I'm going to start from the top. So I still have then the January 1st beginning inventory. That was beginning inventory. And that equaled 200 times $8 each. That's what they were valued at. And then May 14th, so that's only 200. I need 380 because that's what I have left. So that means the May 14th items are still in there. And those were 100 units at $8.50. And then that's still not 380, so I need 80 more. So August 27th, I had 80 more, and those cost, when they were brought in, $9 each. So my remaining inventory then, since I sold everything that I put in last, what I had in there initially is still in there. So I have 200 units from January 1st. I have 100 units from May 14th. And then I have 80 units from August 27th. So I just need to add up the total value of all that. Now, again, my chart already gives it to me. So I'm just going to go here and say that it was for those beginning inventory was $1,600 worth. And then I'm going to add that to that 850. That is my May 14th 100 units that I put in. So that equals 2450. And then I'm going to add that to 80 times $9 equals 3170. So I have, if I use the LIFO method, last in, first out, my remaining inventory of 300 units is a dollar value of 3170. Now that, I believe that was a little less than what was in there doing it the other way, where I did FIFO. Why did I do FIFO here? It's going to be last in, last out. Sorry, hopefully didn't confuse you guys. So using the LIFO method, last in, first out. Last in was November 18th and August 27th. First in, which was still in there, is January 1st and May 14th. So hopefully that doesn't confuse you too much. It is a little tricky, but again, look on your book on pages 535 all the way to 538 and 39, and you'll go through both those methods. Now we're going to look at one more method here in just a minute. This is the average price method. All right, the last method that we're going to look at is called the average cost method, and this is really the easiest of all, because all you're basically going to do is you're going to take the average cost of everything you have in inventory, and then you're going to multiply that by how many you have left. So in this case, the problem is exactly the same for the average cost pricing. You're still going to have 380 left in inventory, but it's going to be calculated a little differently. So in this case, again, you have 200 units at $8. So I'm just going to write this down, and then I'll show you my screen. So $1,600 for the total inventory on January 1st, and then another $850 for what was put in on May 14th, and then another $2,250 for what was put in on August 27th, and then another $2,625. So it already gives us the total, right? The total is $7,325 in inventory, right? And we had a total of 850. So what we're going to do is we're going to divide the 7,325 divided by 850, and that's going to give us an average price or cost for each of those items. So let's take a look at that here in my sheet. Hold on a second. All right, so I added all those up, all the cost of the inventory, and then I divided by 850. So I didn't do the division yet, but I'm just going to do it here on the calculator. So 7,325 divided by 850 equals, all right, $8, and I'm going to round that to $8.62. So that means the average cost for each of my items in inventory based on that segment of inventory is $8.62. So if I have 380 remaining in inventory, all I need to do is multiply that by $8.62. So let's just leave it on there and do times 380, because that's what I have left in inventory. So that's going to come out to $3,274.71. So that is my average cost for this particular problem for Best Buy using the average cost method. It's going to be $8.62 per unit, and that's going to be multiplied by the 380 I have left. Means I still have $3,274.71 in inventory, and that would go on my income statement as ending inventory. So, all right, hopefully that helped. Again, I would encourage you to look through the book. These are not difficult, but I wanted to at least give you an opportunity for me to work through it with you. Hopefully it wasn't more confusing than it was helpful. But have a great week, and I'll be moving on to depreciation next. So be watching for that video. Have a great week, everybody.